Hello there guys, I'm KOMMONFOREX, the Marksman. Welcome back to the channel. In today's video, we'll be talking about 4 main entry techniques I use as a Forex trader. These are the 4 main techniques I use to determine whether the market is going to go for a buy or go for a sell at any point in time. If you're new here, before we start this video, make sure you subscribe to the channel. Make sure you like this video so you can reach as many struggling traders on YouTube as possible. Also, make sure to hit the notification bell so you get notified anytime I go live on YouTube or anytime I drop a new video. We'll be right back. So like I said in the intro, today's video will be more of an intro where I take you on a deep dive journey as to how I take trades on the market, how I take my buys, how I take my sells, how I decide when to buy, when to sell, whether the market's about to change direction or about to keep going. There are 4 main important techniques I use to make this decision as a trader. So let me list these trading techniques here. The very first one is reversals. I look out for breakouts. Third one, continuations. And then the final, correlations. So in today's video, I'll be taking you through these 4 main techniques I use. Reversals, breakouts, continuations, correlations. These are the 4 main techniques I use to decide whether the market is going to go for a buy or is going to go for a sell. These techniques, which are extremely powerful, if you learn to adopt them or embed them in your trading strategy, I can promise you that the decisions you make from now onwards, the setups that you see, the signals that you identify will change the way you see the game from now to the foreseeable future. Let's start with the very first one, which is reversals. And then I derive my reversals through various means. The first one is my support, resistance. So my support and resistance can be on a trend line, can be on a Fibonacci level. So today we'll be using AED-JPY to do all this form of analysis. So now let's talk about resistance. When we talk of resistance, support and resistance, basically resistance is a price point beyond which the market fails to go any higher within a range. You can have the market forming a high this way, travel as much as it wants, go as much as it wants. It always has a price that it always respects and fails to break. The technical terminology we have for that is resistance. So the opposite is what we call the support, which can happen at the bottom of a range where you have the market dropping to form a low, travels for as long as it wants, and then comes back to respect that particular zone. So this is what we call a support, this is what we call a resistance. So let's use this AED-JPY to analyze what we mean when we talk of a support and what we mean when we talk of a resistance. If we look at AED-JPY, we are waiting for price to hit either our support, then to hit either our resistance. Then we use it to decide whether the market is going to change direction or is going to keep going. Let's look at how the candlesticks behave, which level they approach first. The first hits the support. But there's one mistake a lot of retail traders make. We have a concept we call never jumping in front of a moving train. The fact that the market hits your support or resistance level doesn't mean you should immediately jump in to take a trade. So you look at this AED-JPY, you realize that now that the market hits my support, I'm now marking it out, waiting to see a clear indication as to why the market is going to buy in this particular zone or on this particular level. And the main tool I actually use to decide when to take the trade. So the thing about reversals and the thing about my trading techniques is that it tells me where the market is going to change direction. It also tells me when it's going to change direction as well. So you need both the where and then the when. So the where is the support level where we are expecting the market to reverse. And then the when is the candlestick that tells me the market is about to move in the direction I expect it to move into. So now I get a trade, I get the market to hit my support. I want to see how the candles behave, how it reacts on this particular level before I decide to trade. So now I still don't have an entry. I'm going to wait till I get any of my confirmations before I trade. So you see the market comes back to what? To hit my support. Then what do I see? I want to see a clear confirmation. So this is a confirmation I use, which is called a bullish engulfing. I now use my risk to reward to find my entry. So if I'm entering here, my stop loss, also based on market structure, is right at the bottom of this range. I expected the market to hit this take profit. And then I'm also expecting the market to at least make me the 40 pips I risked on this particular setup. So now I'm done taking the trade at my support. I've hit my 2 take profits. What do I do next? I want to see if the market will get to my resistance, which is up here. So let's delete this level. Let's also delete this level. So next thing, the market hits our resistance. We still want to get a confirmation. So I get another candle closing a little bit up there. Then I wait for the next candle, which gives me my confirmation, which is what we call another bearish engulfing. So this is the opposite of the confirmation we got here. This is a bullish engulfing. I go my bearish engulfing here. Same process. I use my risk to reward to plot my entry price. Always make sure you make at least what you risk on every trading position. So here we smash all our TPs with this. So this is a simple resistance and support strategy I use as a trading technique. Let's go to the next tool, the next reversal tool, which is the trend lines. So with the trend line, let's look at something on Euro GBP. This is a trade I took in the past. I'll explain how I took this trade and then how I was able to catch this trade as well. So with my trend line, I actually need to see three things on my trend line. The first one is my point of inception. The second one, my second point to draw my trend line. And then the third one, I need a third touch on this trend line for entry. This was the beginning of the downtrend, and then this was my second point, which was point B, and then my third point, which is now at the bottom here. I just wait to see the market hits the trend line for the third touch. Once it hits it for the third touch, I now look for my entry with a confirmation. I actually got a setup that gave me less than 15 pips of stop loss. So I actually risked less than 15 pips on this particular trading setup. Let me show you how it looked like. My entry was after this tweezer. So you can see this small tweezer top here. This was where my entry price was. My entry was here. You can see what my stop loss was. It was extremely tight. So I risked about 10 pips on this particular setup. So after getting my entry here, this is how far the trade ended up going. So smashing both take profits, sat on the second level. Then it ended up going back down, hitting my third take profits, and even went further all the way to support level at the bottom here. And the final technique I use to catch reversals on the market is what we call Fibonacci. So Fibonacci is a tool I use to catch the depth of a pullback for a retracement. So now let's look at the same AUD JPY here. I want to see if this is going to reverse all the way back to my resistance, or it's going to pull back in the middle and then drop back down. So the whole point of using Fibonacci is to catch a setup like this. You have your market moving from, let's say, your point A to up here like your point B, then it gets to the middle somewhere here, then it starts dropping. So when it starts dropping, it actually doesn't come all the way back down to where the move started from. It drops midpoint or somewhere here in the middle. Any point here ends up here, then it ends up going back up to continue the prior move it was doing. This is what we use Fibonacci for. So in Fibonacci, it means that you're trying to catch the prior move it did before it actually had the retracement, before it made the retracement or the pullback it did here. So if you're using your Fibonacci, it means you want to see how far this will pull back before it reverses and goes back to continue the prior move it did earlier. What we do next is to plot our Fibonacci tool. If you want to identify your Fib retracement, you can actually find it in the left side of the plane here. Take Fib retracement and add it to your favorite. It will appear on the horizontal ray you have up here. So now I click on Fib retracement. I start from up here all the way back down to the end point of the swing move. My key Fibonacci levels are the 50%, the 61.8%, as well as the 78.6%. These are the key levels I use in catching my Fibonacci. And then the 0 represents where the move ends. The 1 or the 100% represents where the move starts from. We want to actually be sure that the market is going to reverse anywhere within this range you have here. So next up, what do? We just want to wait for the market to react to our Fib. You have a strong candle penetrating the 50% level. What Fibonacci simply tells us is that if there is a pullback or retracement, it means that the key Fib levels is where the pullback or retracement is going to end up before it goes back to continuing the prior move. You can see a double top appearing on the 50% exactly. And then at the end of this double top, you also have what we call a bearish engulfing. Our entry price right at the closure of this candle, our stop loss on the 61.8. So we actually make about 90 pips on this setup before it pulls back. And the next technique I use to take trades is breakouts. Let's say you have a move starting from here, getting to this high, creating a new high. Let's say it moves, does whatever it wants to do for a few days, for a few weeks, then comes back to the resistance. We normally expect the market to normally bounce off from here. But there are so many instances where the market can consolidate here for a bit, dance around this zone, then just break out and go all the way up. So this is what we call a breakout. A breakout simply means that now the market has actually extended beyond where you're expecting a reversal to happen. So it means that most likely the market is about to keep going where it was going initially instead of changing direction in the resistance zone you had here. Let's go back to the chart and then look at an example of this breakout you had here. So let's look at this minor resistance zone we have here. You can see the market creating a lower high from this particular high here, creating this lower high, and then you're using this lower high as a form of resistance because the market has actually respected it. So once the market gets to your support or resistance zone, the first thing you want to look out for is consolidation, how far the market consolidates in that zone. Then the next thing you want to look out for is the candlestick confirmation that happens in there. That tells you that the market is going to either change direction or going to keep going. We look at how the candles behave here. You can see the market has already started consolidating. So look at how long the market actually consolidated in this zone. The market ended up consolidating there for very, very, very long. So what I do when I see some sort of long pause consolidation like this is, I normally expect a continuation to happen. I normally expect a breakout from this particular zone, meaning that I want to see a full-blown candle close beyond this zone. That tells me the market is about to keep going up instead of reversing on this particular level. So now what do I do next? I just wait for the breakout candle. Once I get this particular candle, it means that the market is going to keep going in the direction it's going instead of changing direction here. So after this breakout candle, what I simply do is to just wait and catch my trade somewhere in here. Then where do I have my stops? I have my stops on the support level, on the previous resistance, which was also here. My stop loss is just here, meaning I'm risking about 35 pips on this particular setup. So I'm trying to catch this breakout to the upside. So you have your breakout in here, and the market goes all the way to hit the previous resistance you're expecting on this. The third trading technique I actually use to find entry on trades is what we call the continuations. So I normally target continuations anytime the market gives me a huge rise or a huge drop. So after getting the sell on this particular trade setup, long candle gives us here. Now what happens next is normally you usually get some form of consolidation happening in here. A consolidation simply means that the market's taking a pause because both the buyers and sellers are fighting to gain control at any key level or any particular zone on the market. So now you have another candle. So normally when we have consolidations, it means that candles will just align next to each other. You normally have about 4, 5, 6 candles, can be as many as possible. But when I'm trying to catch continuations, what I actually want is at least 4 candles consolidating in any zone. After watching the candles consolidate in that particular zone, I simply just wait out for the breakout candle. Then I use it to actually trade the continuation back to the downside. So the same thing happened on this particular setup on AED-JPY. So the continuation means that now you've caught the trade here. But getting the pause here means that now the bulls were trying to regain control, but the bears were way stronger than the bulls. What does it mean? It means that you're expecting the market to keep going down from this particular level. So if I'm catching this trade continuation, what it simply means is now I'm taking a short position here, but my stop loss is right on top of the consolidation. That's the difference. My stop loss is right on top of the consolidation, which is about 33 pips. So having my stop loss right on top of the consolidation also means that my take profit can also be close. Looking at structure, I look at here, and then I use this as a point for my final take profit. So this is simply a chart pattern I use, which I call the bearish triangle. Bearish triangle because you can draw a triangle through the consolidation you have here. So you realize that I can easily draw a triangle through the consolidation, meaning I'm expecting the market to actually break and go to the downside because of this bearish momentum I had. So now my next candle, boom, I smash my initial take profit, then it keeps going down for me. So this is how you catch a continuation with just, the chart pattern known as the bearish triangle. So this is how I catch a continuation trade as an entry technique. And then the final one is what we call correlation. Correlation simply meaning the relationship that certain currency pairs, indexes, or commodities have with each other. It means that it can either be a positive relationship, meaning that if currency A goes up, currency B also go up, or a negative relationship, meaning that currency A goes up, currency B comes down. That's what a relationship is. So this particular relationship helps you take trades on a currency pair which might not have even given you a setup. Make sure you embed these trading techniques in your trading life, and trust me, it will go a long way to change the way you see the market. It will go a long way to transform the sort of signals and setups you see on the market. So if you find this video extremely helpful, like I said in the beginning, make sure you like this video. That's the most important thing I need you to do for me. Like this video. The algorithm will understand it, YouTube will understand it, it will push it to as many struggling traders as possible who also need to improve their trading techniques as well. Also make sure you're subscribed to the channel. Also make sure you hit the notification bell so you get notified anytime I go live on YouTube or anytime I release a new video. And like I said in my last video, I'm actually preparing an amazing beginner course for you guys. I'll actually be dropping this video when we hit 2,000 subscribers. We are currently almost at 1.5k subscribers, so we need 500 more subscribers and I'll be dropping this amazing video for you guys. So if you're a beginner, also make sure you're subscribed to the channel. You keep up with me on my socials, KOMMONFOREX on Instagram, and then KOMMONFOREX on Twitter as well. Click in the link in the description to join the KOMMONFOREX trading community where I drop trading signals and trading nuggets and trading insights on a daily basis. Also click in the link in the description to sign up with my recommended broker as well. Thank you for joining me for today's session. I hope the lesson was extremely insightful. I hope your trading game will be changed after watching this video. I hope you're going to embed everything you've learned here in your trading life, in your trading strategy, and it's going to take your analysis, it's going to take your profitability to the next stratosphere. See you in the next video.